Hello everyone. Now let's talk about the depreciation methods. And in this level, we're going to be only going over three types of depreciation methods. The first one is the straight line depreciation, and it's very easy, it's very straightforward, and as the name implies, it's just straight line, it's straightforward. Then we have the units of activity depreciation method, and this is based on the number of units produced or the numbers of hours an equipment has been used, or something that's related to activity or productivity. And then the last method that's a little bit tricky, it's called the double declining balance depreciation method, and sometimes they classify it under the category of accelerated depreciation method. It's not necessary for a company to use only one method of computing depreciation for all of its fixed asset. You can have a combination of different methods in different groups of fixed assets. So now let's talk about the straight line method. The straight line method provides for the same amount of depreciation expense for each year of the asset's useful life, and that's why it's straight line. So every year the amount of depreciation is going to be the same. So once we calculate it at the very beginning, it's going to be the same all over the life of that fixed asset. So let's see how it's calculated. So in order to calculate the annual depreciation, we get the historical cost, which is referred to here as cost. Then we subtract the residual value, or sometimes we call it the scrap value or the trade-in value. And then whatever we get, we call it the depreciable cost. And then we divide that by the useful life. Once you do that, you get this amount that is going to be used in the adjusting entry for depreciation every single year. So in our case here, we had $24,000, which was the initial cost of that asset or this equipment. Then we subtracted $2,000 for the residual value, and then the expected useful life was 5 years, so that gave us $22,000 divided by 5 years, and it's $4,400. So as you can see here, we got the allocation of the $22,000, which is the depreciable cost over the 5 years, and it's $4,400 every year. Year 1, year 2, year 3, 4, and 5, they're all the same. One thing I want you to notice is that we have something here called the straight line rate, which is 20%. And how they got this is simply they get 100% divided by the useful life of that equipment. So 100% divided by 5, that's 20%. You can take this 20% and multiply by the depreciable cost, and you get the depreciation expense per year. So computing straight line depreciation may be simplified by converting the annual depreciation to a percentage of depreciable cost. Again, I have to admit, not everybody might find this to be easier or more straightforward, but again, it's a different approach. It could be easier for some of you. So the straight line percentage is determined by dividing 100% by the number of years of expected useful life. And here we have some examples. So for example, if we have an asset that has a useful life of 5 years, we just take 100% divided by 5, and that would be 20%. So we take the 20% and multiply it by the depreciable cost, and we get the depreciation expense per year. If we have 8 years, then 100% divided by 8, and that's 12.5%. 10 years, that's 100% divided by 10, and that's 10%. 20 years, 100% divided by 20 years, and that's 5%. 25 years, which is the longest here, 100% divided by 25 years, and it's 4% per year. As you can see, it's an easy conversion. The only thing, remember, once you have this percentage, you take it and multiply it by the depreciable cost. So let's see the journal entry. Technically, it's not a journal entry, it's an adjusting entry because we do it on year end. So at the end of the period, we apply the adjusting entry for depreciation. So it's a very standard journal entry. We've seen it before. We know it from chapter 3 when we were going over adjusting entries. The only thing that we learned is how we're going to calculate the values. So depreciation of the forklift for the first year using the straight line method. Remember, we had an example of our forklift. We're going to debit depreciation expense, and we credit accumulated depreciation. And the values that we use here is the $4,400. And it's going to be exactly the same journal entry from year 1 through year 5, which is the useful life of that asset. Remember, accumulated depreciation is a contra asset account, so it has an opposite nature to asset, and we all know that assets have a debit nature. So something that's contra asset has a credit nature. So when we are recording accumulated depreciation on the credit side, this means that we are increasing the value of accumulated depreciation. Depreciation expense, it's an income statement account. It appears on the income statement. It has a debit nature, and we're recording it on the debit side. So accumulated depreciation accounts are called Contra accounts or Contra asset accounts. This is because accumulated depreciation accounts are deducted from the related fixed asset accounts on the balance sheet. So we'll see how it looks on the balance sheet. So before we go there, the difference between fixed asset account and its related accumulated depreciation account is called the asset's book value, which is this value here, the $19,600, or net book value of the asset. So the book value of the forklift at the end of the first year would be reported on the balance sheet as follows. So it's going to be $24,000, which is the original cost of the equipment, minus the accumulated depreciation, which is $4,400, and that will give us a book value of $19,600. One thing I want you to remember, the residual value of the asset never appears on the financial statement or on the balance sheet. It's something that we just only use for calculation. It can be reported somewhere else, but we never report it on the face of the balance sheet. So in this slide here, we're going to see how things are going to look like. So you see here the depreciation expense per year is pretty stable, $4,400 for year 1 through 5. But the book value keeps going down, keeps declining from year to year, because the accumulated depreciation will keep accumulating. So the first year was $4,400, second year the accumulated depreciation will be $8,800, and so on. And we deduct the accumulated depreciation from the original cost to get the book value. So you can see that the book value will keep going down year after year until it reaches the residual value in year 5. And that's how the mechanics of depreciation works. Now let's see the other method, which is units of activity method. And this is a method that's based on production. So it doesn't have a stable kind of depreciation expense from year to another. The depreciation expense varies with the use of the asset. So the units of activity method, sometimes they call it units of production method, provides the same amount of depreciation expense for each unit of activity of the asset. Depending on the asset, the unit of activity can be expressed in terms of hours, miles driven, quantity produced. So again, depending on the kind of asset. So if I'm depreciating a truck, I'll use the miles driven. If I'm depreciating a printer or a photocopier machine, then I'm use the quantity produced. If I'm using some other asset like a pump, I would use something like the hours used. So it depends on the kind of fixed asset that we are trying to apply depreciation on. So the units of activity method may also be called the units of production method or units of output method. So let's see how it works. It's actually a two-step process. Again, very logical, very similar to straight line. The only thing, instead of dividing by the useful life of the asset, we divide by the estimated units of activity. So here we have the first step. We determine the depreciation per unit as follows. So we try to get the depreciation rate. So we get the cost minus the residual value. And again, remember, cost by cost we mean the historical cost, how much we paid in order to acquire that asset or that fixed asset, minus the residual value or the scrap value, how much we expect to sell it for when it retires. And then we divide by total estimated units of activity. So that's the only difference between the straight line method and the units of activity method. In step number 2, we compute the depreciation expense, where we get this rate that we just calculated, and we multiply by the units of activity for the period. So let's see an example to see how it works. So assume that Exter forklift costs $24,000. Its estimated residual value is $2,000, and it's estimated to have a useful life of 10,000 operating hours over the life of the asset. So you see here, instead of having a useful life in terms of time, like 5 years, here we have it in terms of 10,000 operating hours. During the first year, the forklift was operated 2,100 hours. So the units of activity depreciation would be calculated as follows. So the first step is to calculate the rate. So we get the depreciation per hour, which is the cost. In our case here, it's 24,000. And then we subtract the residual value, 2,000. And then we divide it by a total estimated units of activity. This is, again, it's an estimate. It's not an actual number, but it should be like an educated estimate, like something that's based on historical value, based on the industry. So we know that it's usually works around 10,000 hours. So the rate here came out to be 2.20 cents or $2.20 per hour. So to calculate the depreciation for the first year, we get the depreciation per unit, which we just calculated to be $2.20 per hour, and multiplied by the units of activity for the period, which turned out to be 2,000 hours. So we multiply that and we get it to be 4620. The journal entry or the adjusting entry is exactly the same. So to record the adjusting entry, we debit depreciation expense for the forklift, and we credit the accumulated depreciation for 4620. This value is not going to be the same every year, unless the number of hours used from a year to another turned out to be the same. But in real life, it's hard to get the exact same hours or exact same usage of an asset from one year to another. So assume that during its 5 years life, the forklift was used as follows. So we have like 2100, 1500, 26, 18, 2000, and the total, we had like the 10,000 hours. So in this case, you can see there's a variation in the number of hours used for that forklift. So that would lead to that the depreciation expense would be different from one year to another. You see here it's 4620, 3300, 5720, 3960, and 4400. So there's a variation. It's all over the place depending on the usage of that forklift. But the thing that you'll notice that the amount of book value for this forklift is also going to decline. However, it's not going to be declining in a straight line or going to be like a steady decline. It would vary depending on the usage of that forklift. But at the end of the 5 years, the book value has to be $2,000, exactly like the Straightline method. The last method, which is double declining balance method, this is again one of those accelerated depreciation method. It provides for declining period expense over the expected useful life of the asset. It's a little bit different. The concept is slightly different. So we have to try to forget about the other two methods, and we'll see how we're going to apply a new approach. However, the only thing or the only connection with the straight line method is that we have to calculate the straight line rate before we get the double declining balance rate. So the double declining balance method is applied using the following 3 steps. In the first step, we determine the straight line percentage using the expected useful life, and we've seen that in the first method. In the second step, we determine the double declining balance rate by multiplying the straight line rate by 2. So that's an easy step. However, from my experience, most students forget to do this step. They just, for some reason, they use the rate as is. But what you have to do is that you have to multiply by 2. And an easy way to remember that is the name of the method. It's double. So because it's double, we have to multiply the straight line by 2. And then, in step number 3, we compute the depreciation expense by multiplying the double declining balance rate by the book value of the asset, not the depreciable cost. And that's another very common mistake. So you have to multiply by the book value of the asset. So in the very first year, the book value of the asset is $24,000, not the $22,000. Don't use the $22,000. Don't use the depreciable cost. We're going to use the $24,000. The second year, the book value would be different because we're going to deduct the accumulated depreciation. So we'll see an example and we'll see how it goes. So for the first year, the book value of the asset is its initial cost. Please remember that. So let's go back to our example. Assume Astor Company purchased a new forklift on January 1st as follows, where we have the initial cost of $24,000, the expected useful life to be 5 years, and the estimated residual value to be $2,000. For the first year, the depreciation is computed as follows. So we get the straight line percentage, which is 100% divided by 5 years, and that would be 20%. In step number 2, please don't forget it. You have to take this rate, 20%, multiply by 2, and that would be 40%. So let's say we had this percentage, straight line percentage, to be 10%. So we multiply by 2, and it's going to be 20%. In our case here, it's 20%, multiply by 2, that's 40%. And then step number 3, we calculate the depreciation expense by getting the original value or the book value of the asset multiplied by 40%, which is the rate that we just calculated, and that would be 9,600. And this is the value that we're going to be using in our adjusting entry. So you can see here the adjusting entry, we're still debit depreciation expense, credit accumulated depreciation for 9,600. I don't know if you noticed, but this is a much bigger value compared to the straight line method and the units of output method. So we expect in the double declining balance method that the amount of depreciation would be extremely high in the first year or in the very first few years of the asset's life, and then it keeps going down until the last year of the asset. So here we have a table that shows how the double declining balance method works. So you can see here that we started with a cost 24,000. We multiply by 40%. We got the rate. Then we got the depreciation expense. We deduct the depreciation expense from the book value, and that turned out to be 14,400, and that's the ending book value that's going to be used for next year's depreciation expense. So accumulated depreciation now is 9,600. And the book value is 14,400. Take it again, multiply by 40%, and the amount of depreciation now is declining, 5,760. So we deduct 5,760 from the book value, 14,400, and we give you a new book value, 8,640. And now our accumulated depreciation turns out to be 15,360. And how did we get it? It's the 9,600 plus the amount of depreciation for the current year, and it turns out to be 15,360. Deduct the 15,360 from the 24,000, you get the book value. The book value now is 8640. Take the 8640, multiply by 40% again. You can see that's 3456. And then if you add the 3456, if you deduct the 3456 from the book value, that would give you the new book value, which is 5184. And then this is going to be our beginning book value of the year. Then you take this value, the amount of depreciation expense for the year, add it to the 15,360, and will give you the new accumulated depreciation deducted from 24,000, and that will give you also the same value for the book value at the beginning of the year. Multiply by 40%, get the 2,073. The 2,073 deducted from the 5,184, you get the new book value at the end of the year. For the very last year, we're not going to multiply by the double declining balance rate. So the last year is different, because if we multiply by 40%, the amount of depreciation would be different, and that would lead to a book value that's not equal to the residual value. We want the book value at year 5 to be equal to the residual value, which is 2,000. So what we do, we actually force it. We plug in an amount. So what we do with it, how we do that, we just see the difference between the 3110 and the desired ending book value, which is $2,000, and that would be our depreciation expense for the year. So we take this depreciation, and that's the amount that's going to be used for the journal entry, or for the adjusting entry. So as it says here, the estimated residual value for the forklift is $2,000. However, when the double declining balance method is used, the asset should not be depreciated below its estimated residual value. Therefore, the depreciation for the 5th year is $1,110.40, which is the 3110 minus the 2,000, which is the difference between these two values. Remember, that was our book value, and that's our desired book value. So the difference is the depreciation expense. We're not going to plug or use the 40% here. And then when you add this 1,110 to the 20,889, the total of the accumulated depreciation would be 22,000. So the depreciation for the 5th year is 1110.40, which is calculated that way, instead of 1244.16 multiplied by, which is the 40% multiplied by 3110.40. So we don't take this number and multiply by 40%. We don't take the 3110 multiplied by 40%, because that would give us a different depreciation expense that would take us below the desired book value of $2,000. So the double declining balance method has a higher depreciation in the 1st year of the asset's life, followed by declining depreciation amounts. For this reason, the double declining balance method is called an accelerated depreciation method. Again, let me stop here. In the next video, we're going to compare these methods, and we'll continue the chapter. Thank you.